Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today we are going to be taking a look at Novo Nordisk. This one did come in by request, but I bumped it up to the top of the list because it fell nearly 20% on Friday. And so I thought I'd take a look and see what my buy price is for this one and share it with everybody. As always, this is not individual investing advice. This is just how I analyze stocks. For this stock, today we're going to be using a time until payback analysis. I used to do this with a few dividend stocks on the channel, and I'm going to do it with more earnings-based stocks when appropriate going forward. So, Novo Nordisk, pharmaceutical company. This is going to be the U.S. listing on the I think they're on the NASDAQ, but they are out of Denmark. And let's see. So we have a long history, pharmaceutical drug company, basically. So the reason the stock fell so much is because they had some trials that came back slightly below expectations for their newer version of the weight loss drugs that they have out right now. So I'll talk about that in just a minute. But the main thing I want to look at here is the historical earnings of Novo. And even if we go before the weight loss drugs, let's even go before COVID. They had really solid earnings. Earnings were 14 cents in 2004, nearly 10 times that by the time we get into 2020. No complaints there. Investors who bought back here, that was kind of during a recessionary period, and then they had more than a 10x, more like a 13 times. So really good performing business. Usually my form of analysis isn't great for pharmaceutical companies. But I do use it if they're big enough and they have enough kind of drugs in the pipeline and they have a long record like Novo does. So it's not the ideal method to use because it uses historical patterns to kind of extrapolate out into the future. I'm actually just going to use some kind of common sense earnings growth forecasting here instead. But it can be good to put numbers to things when they start getting a little kind of wonky like this. Let's see, I think right about here is the time frame I want to use. I do have a 25% off affiliate link for Fast Graphs down in the description if you want to try it out. They have free trials over there. I'm using their new beta version right now. It's pretty slick. Very similar to what it was before. It seems to work a little bit faster, especially once you get the hang of some of the new shortcuts and everything. So, but what we can see here is this is kind of the peak of the weight loss drug hype, and then it's down 40% off its highs in, let's see, less than 6 months, right? So that's tough for anybody that's purchased the stock in the past year or so. They're probably underwater after today, and I imagine many of them are wondering what the heck they should do. So I can't say exactly what a person should do, but I'll tell you what I will do. Really what I want to do is to try to put some basic numbers if we assume certain earnings growth rates and determine how long it would take to earn our initial investment back via only Novo's future earnings. So in other words, if I paid $100 for the business, how long would it take for that business to earn $100 in earnings? Very simple. It can be good to do analysis this way because it puts a little bit more of kind of the time aspect and the risk of time on it. The longer you go into the future, the more likely it is a business will fail. So you want to get this, when you start getting into the really long time frames, then you know that the stock is probably overvalued, right? Maybe we'll just run the numbers really quickly. It peaked out, we'll just call it 140, looks like 140, we'll call it 148. That was the peak. We'll look and see what the valuation looked like then compared to now, but I'll also share the price I'd be willing to buy the stock. So let's get into the spreadsheet here. So what I'm going to do is we have, let's see here. Where's the price? Oh, it's exactly 85. It was throwing me off a little bit here. Okay, so the price is exactly $85 per share. Now, if I adjust that for the debt, I'm going to treat it like it's trading at 123.25. And the way that I do that is I look on the fast graph, I see what the total enterprise value is, which is $419 billion. Then I see what the market cap is. 288 billion. And I basically just look at how much higher is the total enterprise value than the market cap. So like if you were going to buy this business, it's like buying the business and paying off all the debt, and then you get to subtract any cash out from that. So that's how it works. So it'd be like the total cost of buying like the business debt free sort of. And so what I do is instead of doing anything too fancy, I just raise the stock price to account for the difference that I would have to pay, the extra. Now, if they have cash, sometimes the price gets lowered. The effective price for valuation gets lowered using this method. But these guys are actually about 45, you have to pay about 45% more in order to pay off those other obligations. So that means the stock price is really more like $123 instead of $85. So that's what I'm using for these calculations. When I do that, the earnings yield, which is the earnings over the price of the stock, very simple calculation, is 3.27%. Now I'm using $4.03 in earnings, which I also get from the fast graph here, and I'm going to look forward 1 year to 2025. So I'm pulling this year forward. As this year goes on, I mean, this will change a little bit, but I'll already have made that adjustment as we go into the new year, basically. So that's being a little bit generous on my part, but that's how I like to do it, because otherwise you'll be constantly looking backwards, and I'd rather look forwards, and as the year goes on, it will be looking forwards less. This is kind of the maximum that I usually look forward, unless it's like a super fast growth stock. So, which these guys actually have been a pretty fast growth stock. But anyway, I'm starting with this $4.03 in earnings. So it's basically $4.03 divided by $123.25. That should get you the 3.27% earnings yield. And you can compare this earnings yield to like a bond yield. Now, stocks and bonds are different, of course, but if you have a bond that yields this much and you had a business that yielded this much, you would still get the same amount of money that you would be able to go spend at the end of the year. The difference is a good business will grow. So these earnings will grow each year. And that's what I calculate in here. I'm assuming 15% earnings growth for Novo going forward until they pay us back an equal amount that we would invest in the stock. So let's see, to give you an idea. So if we take this time frame, which is about 10 or 11 years here, because they're going to forecast forward 2 years on the fast graph, they come out with like a 15.47% earnings growth rate. So I mean, I think mine is fair. If you look at next year, it's supposed to grow at 26%, but we're pulling that forward. After that, right now that the analysts are looking at 19. So I definitely think we're in the ballpark. I don't think we're being. And then you look at the years before, we have a 20% growth year here, a 20% there, a 14 there. So they definitely have the ability to grow earnings. Now, nobody knows exactly how fast earnings are going to grow, but I think 15 is a good baseline to work with. And we can test some different ones later if we want to see how they work out. But that's just to give you an idea. I think, my guesstimate on earnings is reasonable. So I'm going to use that 15% earnings growth. So this $4.03, which when adjusted for, let me see, I froze up here. There we go. Okay. Which when adjusted, like if you make a $100 purchase, what we want to know is how much we would earn on our $100, which is actually $3.27. So let's go. Oh, wait. Yeah. So what I want to know, we can go a little bit farther. This is a long spreadsheet, but I'll show you how it works. So we have our $3.27. So if that grows 15% the first year, we would earn $3.76 the first year, and then that would grow at 15% more, and that would grow at 15. And each year we could collect this money if we own the business. And we want to know how many years it would take us to collect that until we get to 200, because we start with 100, so we want to earn an additional. And it'll cross that threshold in year 12. And so the time until payback, which is what we want to know here, is 12 years. Right now on the S&P 500, 14 years is about the time until payback on the average. So I think that this is actually a little cheaper on a relative basis if they can grow earnings at 15%. Now, originally when I was tracking this stock, I was a little bit more generous, and I was tracking it with a 20% assumption for earnings growth. That would be 10 years. 10 years is about usually where I actually want this to be valuation-wise before I buy the stock. Let me see if I can, let's go back to 15 here. But I'm going to use this 15% instead of 20% now. I think it makes sense. There's so much competition now in this kind of race for weight loss drugs that probably not just one company is going to dominate. It's not necessarily going to be like a first mover type of a thing. But I do think these drugs could be kind of game changing socially, especially in the Western world where we eat too much food and have this kind of sugar spikes and all these kind of problems that give us all kinds of bad cravings and stuff. It could really change society and also change the way a lot of these other businesses make money. You think food companies, healthcare companies, health insurance companies, all these other businesses that make money off of people that are obese, basically weight loss companies, gyms, I mean, you can still go to the gym whether you need to lose weight, but the point is there's a lot of businesses, and a lot of them are in the S&P 500 that make money overselling people, consumables, and then trying to cure the problems that those make. So if that comes down, and we've seen this with a lot of food and beverage stocks lately, they're not going to earn as much money as easily as they have been able to in the past. So in my mind, I think if I can get some of these weight loss drug companies at a decent price, I really do want to own a few of them, because there's probably going to be more and more limited places in the market that can really grow earnings going forward. And this might be one of the few areas where we can get good growth over the next decade. So if I can get one of these, I'm definitely willing to take a chance on it. So when I do run the numbers, if we use 15% growth, the price the stock needs to get down to hit 10-year payback, which is what I prefer, it's $62 per share. So that would be my buy price right now. My one kind of wrinkle or caveat I would say is if the stock price fell, which I think it's at 85. It's at 85 now. I think one of my buy prices is at 83. When I was using like 20 a share or something. Oh, that was using my other method. Sorry, that's in this full cyclical investor club service. They're all about the same here, but the point I want to make is if it's below 85 and it comes down and makes a bottom at like 70, 69, and then it kind of starts to form a bottom and come out and it gets some positive momentum, I would also be willing to buy in that situation too. But as far as on the way down, assuming this earnings expectation doesn't change a lot, the $62 level, I would be willing to buy it on the way down if on Monday we just woke up and there really wasn't any news and the stock price fell again. So, and I think in terms of a relative value, it looks pretty good compared to the S&P 500 right now. So if a person had money and they really wanted to put it to work and they didn't want to hold any cash or anything, it's probably not a bad option right here for a small position, like a starter position. And then a person could add to it as it went down. But for me, I would really there's a lot of risk we don't know. I don't know if earnings are going to grow 15%. So I want to get a little margin of safety. So I would say the distance between 85 where it's at now and 62 is pretty much a margin of safety. And that's what I'm going to personally aim for, unless we get a clear bottom and things are starting to smoothly go up and momentum changes. And it's still below 85. If it falls to 68 or 69 or 70, and then it starts rising and it gets up to like 78 and the momentum's good, I'd be willing to come in there too. Okay, hopefully you found this useful. If you did, hit the like and subscribe button. I have a free tier over on Patreon. Consider joining that. I post all the YouTube videos over there too. And if you give me a request, it's not an S&P 500, I post those over on Patreon at $5 a month tier level. I also have a $25 a month tier where I share a stock pick each week, whatever I can find in the market that week that looks the best. That's what I share, instead of waiting necessarily for them to get all the way down to my buy prices. So far, since I started that in October, I have already owned the ones that I've recommended so far. But that might not be the case because there aren't a lot of cheap stocks right now in the market. So I might just have to take whatever the next best one that I can find here is soon. So check that out if you're interested, and I'll see everybody later. Bye.